Okay, good morning. We are going to cover Chapter 12 today, which is the Statement of Cash Flows. So this was that statement that we have not talked about much before. But before we get there, just some reminders. First question, publicly traded companies have the option to produce audited financial statements. Wow, 96% correct. That's awesome. And the key word there, of course, is option. Option is what is making this statement incorrect. They're required. So if you're publicly traded, you are required to produce audited financial statements. So you have to have an independent auditor in to audit your financial statements. So excellent on that. This question is actually going to close fairly soon, so if you're just joining us, get logged in pretty quickly here. Okay, some announcements. This Wednesday, KPMG, for those of you that don't know, KPMG is one of the big four accounting firms. They're international. They're going to be here on Wednesday afternoon outside this room from 1 to 4. So they have a table set up and you can get information from them. The reason I'm bringing it up is they have information about their sophomore summer leadership program. They have an opportunity that you can participate in something in the summer, and they have information that is for sophomores, which if you're an accounting major, if you're in this class, you're that target for that summer leadership opportunity. So if you're an accounting major, this is an excellent opportunity to maybe start networking, growing some connections with potential jobs. And again, KPMG is one of the big four, and they hire lots of people. Okay, so there's that. There's a handout for today. If you're online, you will have gotten it. It's a sideways handout, landscape orientation, so the page numbers when I refer to it. We're going to use the handout today and Wednesday. Okay, so let's do this weekend, Chapter 12 homework. I'll be sending out the step-by-step videos later today. Maybe you want to send me an email to remind me? That was to Amir, not to everyone. Chapter 12 homework. And then the final exam. I did want to point out, if you are taking the exam in the computer lab, our exam runs, well, wherever you're taking it. The exam starts 9 a.m. Monday, May 9th. Sometimes you can start a little bit early. Through Wednesday, May 11th, you have to start by 4 p.m. The computer lab, the Proctor lab during finals week is historically very, very busy, potential for long lines. So my advice to you would be to go early in the day. Typically early in the day is better in terms of getting a spot. So, and then if you're with Proctor you should schedule, if you've not scheduled yet, to schedule as soon as possible, at least 72 hours in advance. Okay, extra credit, just a reminder, we've got another week or two left on the My Accounting Lab Accounting Cycle tutorial. If you have any questions, again, send me an email, describe what you're having trouble with, and send me a screenshot so I can see your numbers, and we'll get back to you. Do not wait till a day or two before it's due. It's something that you probably need to do over the course of a couple weeks. Gotten several photos submitted. I will not be looking at those until Saturday, after Saturday. The photo extra credit contest is due this Saturday, so get your photos submitted. You can submit one. I have 5 listed there. Not that you could submit 5. I will grade the last one submitted. I just want to do that to so that if you submitted one and then you thought of something better, you could resubmit without having to contact me to cancel it and all that stuff. So that's why I will grade your last submission. And same with the phrase. So you submit, one phrase gets graded, it's the newest. Okay, so there's that. So the 2 extra credit, the photo and the phrase, are due this Saturday. The accounting cycle tutorial in My Accounting Lab is due next Saturday. And just a reminder, the extra credit project, the one that's in My Accounting Lab, will impact your grade until Sunday, May 8th when I remove it. You will never see the extra credit scores on your grade in My Accounting Lab. My Accounting Lab is not technically set up to hold extra credit, so I will make those adjustments before I do the letter grade and slash line. Okay, so now on to Chapter 12, Statement of Cash Flows. So up to this point, we've looked at 3 statements in the class. We've looked at the income statement. The net income goes on the next statement, which would be the statement of retained earnings or statement of stockholders' equity. And then the ending retained earnings balance goes on the balance sheet, which is the 3rd statement we looked at. And this is really our first exposure to the statement of cash flows. So the statement of cash flows says, where did we get our cash during the period? What did we do with our cash? Some investors consider it to be one of the most important statements. If you were ranking importance, certainly it's important on income, but cash is important too. The statement of cash flows is a relatively new statement. The other 3 statements have been around for a century or however long we've been doing them the way we have been doing. The statement of cash flows did not become required or commonly prepared until about 1986, which is new in accounting terms. So it's the newest statement. Investors were demanding more information, and that's how it came about. So, statement of cash flows. We said that it's the statement that reports where we got our cash and where it went to. So our cash receipts and our cash payments. It covers a span of time. So it's going to be typically for a year, but it could be for a quarter, it could be for a month. The statement of cash flows, I've dropped this part of it, but the statement of cash flows is always for cash and cash equivalents. And cash equivalents are things like certificates of deposit, the short-term marketable security. There's things that are virtually cash. If you went to the bank, you could get it out. So everything when we talk about beginning cash, ending cash on the statement of cash flows, it includes cash equivalents. So the statement of cash flows in concept is pretty simple. Where did cash come from? Where did cash go? Remember that when we do our accounting, we're on an accrual basis. So we're saying, well, we can recognize revenue this period even if we're not getting the cash until next period. We can recognize expenses even if we are paying them next period. We're focused on what happened. But when we come to a statement of cash flows, we're looking at how much cash we have. How much cash do we have to work with? They say that more small businesses fail due to lack of cash than anything else. Cash is not the same thing as income. So you need income, but you also need cash to operate. Okay, so the purposes of the statement of cash flows, now we have this slide on the handout, page 1 in the left corner, the 4 purposes of the statement of cash flows. First of all, it helps predict our future cash flows. Are we going to have more cash flowing in? Investors can look at what cash flows we got and make predictions about what's going to happen in the future. The statement of cash flows helps us evaluate management's decisions. Did management make good decisions, especially with investing and financing? It looks, can we pay dividends and interest? Do we have the ability to pay that? To pay either one of those, we need cash. And then it shows the relationship between net income and cash flows. And so what we're going to be doing in this chapter is I have some real examples of statement of cash flows, and we'll see where those come from. So we're going to go through some basics before then. Okay, so this is on your handout, upper left corner. So this is a good place to start our next question here. Just a quick one. The statement of cash flows is designed to fulfill all the following purposes, except which one of those is not on that list? Okay, right now, 82% of you are correct. I'm not going to give you the answer because you have it on the handout. We just went over it. So the statement of cash flows is designed to fulfill all the following purposes except for which one? Which one is not on that list in the upper left corner? Okay, I'm going to be closing this in 5 seconds. Okay, the item that was not on that list, of course, was to assess the collectability of accounts receivable. The statement of cash flows will not show us can we collect accounts receivable or not. That's not what it's designed to do. It is designed to show the relationship of net income to cash. It is designed to evaluate management decisions and to help predict future cash flows. Those are all stated reasons. Okay, onward now. So that first point objective, very small. Second one now is to distinguish among operating, investing, and financing activities. The statement of cash flows is broken down into 3 types of cash flow activities, and this one is on your handout as well. This one is upper right-hand corner. The types of cash flows activities. So yes, you have to know the 3 types of activities and be able to identify what's in each one. Operating cash flows, those are what we generate because we're in business. So this is revenues, expenses, gains, and losses. This is what makes up net income. These are those things, this is what we're generating from being in business. It's our sales. It's less our expenses that we have from those sales. But operating cash flows are saying this is why we're in business. This is how much cash we're generating from our business activities, from our operations of the business. You may want to put a star. You'll see this over and over and over. Operating cash flows are the most important cash flows when we're looking at evaluating a statement of cash flows, because this is why we're in business. Okay, so next one is investing. Investing cash flows are anything related to long-term assets. So this is where the property, plant, and equipment, if we buy a building or if we sell a building, that's an investing cash flow. We can buy long-term investments in bonds or in stocks. That's investing. So investing, this is where if we're going to grow, we buy more locations, we buy franchises, we buy intangible assets. Investing has to do with long-term assets. So if it's a long-term asset changing, that goes in investing. And then our last pool is financing. And financing relates to debt and equity. Basically, where do we get our funds? We can get our funds from 2 sources, outside sources. It would be long-term liabilities or stockholders' equity. So we've got the 3 cash flows. We've got operating, which is generating cash from the business activities, from operating our business. We have investing, which is long-term assets. And then we have financing, which is long-term liabilities and equity. Okay. Once again, okay, operating cash flows are most important. That is our most important pool. So we need to star that, asterisk it. Operating cash flows are the #1 thing we're going to be looking at. There's other things that are important. There's some things they can tell us when we look at those cash flows, but operating cash flows, we want to see operating cash flows be positive. We want to see the company generating dollars from operating. Okay, now operating cash flows, there's 2 ways to compute operating cash flows. There's indirect and direct, and this is on your handout right column in the middle on page 1, okay? There are two formats. There's indirect and direct. The indirect method starts with our net income, which is on an accrual basis, and then adjusts it to a cash basis income is what we're doing. We're saying, let's adjust our net income off our income statement. Let's make all the adjustments to that and go to a cash figure. Really, how much cash income did we generate? And that's the indirect method. Okay? And then there's the direct method. And the direct method reports all the cash receipts and cash payments from all our activities. So it just says, here's how much we got from this activity, here's how much we got from this activity. The indirect method is the method used by almost all companies in the United States. The indirect method is how our information systems are set up. So in the U.S., the indirect method is the method that's used. It's also the method we'll do. Okay, the indirect method, what we do with the indirect method basically is we start with net income. We start with net income, and then we make a whole bunch of adjustments to it. What we're doing here is we start with our net income, and the first thing we do is we add back depreciation. We're adding back depreciation because depreciation is a non-cash item. We bought the equipment several years ago. We keep depreciating it every year. Depreciation doesn't have anything to do with cash. So if we're trying to convert our income back to cash, we need to make adjustments. So we're going to add back depreciation because it's not cash. We would have deducted it from income to get at income, so we're going to add it back. Then there's a series of other adjustments. So we're going to do a little operating section coming up in a minute about how to do the operating section. So we are only doing the indirect method. The indirect method, the reason the U.S. sticks with it is because that's how the information systems are set up. It would be extremely costly for companies to switch over to be able to do the direct method. That said, direct method is required under international financial reporting standards. So the direct method's there. It's learning objective 4. We are not doing the direct method in here. Okay, because, and just as an example, when I was getting ready for this chapter, I wanted to bring in some sample companies. So I just picked 10 companies. I would pick a company and then pick a competitor. And so of the 10 companies I picked, I didn't look at their statement of cash flows until I went to put it in some format for class here. And of the 10 companies I picked, every single one used the indirect method, which I guess didn't really surprise me. But indirect method is what companies in the U.S. are using, so that's why we're doing it. So we are not doing learning objective 4 in this chapter. Just know that two methods exist. We are using the indirect. The indirect and the direct will come up with the same operating cash flows. So it's only a matter of how we get there, but it comes up with the same operating cash flows, and it only impacts your direct or indirect, only impacts operating cash flows. Investing and financing are the same under both methods. Okay, so before we go any further, another question here. Of the 3 types of business activities reported on a statement of cash flows, investing activities are the most important when evaluating a business. Okay, key word I want to point you out there, investing. Is this true or false? Of the 3 types of business activities, so we have operating, investing, and financing, reported on a statement of cash flows, investing activities are the most important when evaluating a business. True or false? We're going to close this in 5 seconds. Okay, operating cash flows are most important. Cannot stress that enough. When I said put stars around it, operating cash flows are the most important cash flows when evaluating a business. Okay, now So we just kind of zipped through Learning Objectives 1 and 2. Learning Objective 3 is the one we're going to spend our time on, so that's the one coming up. So we're going to do the indirect method. First of all, just a reminder, the 3 types of cash flows: operating, investing, and financing. You should have stars around operating because it's the big one. It's the one that's most important. But you need to know all 3 types and be able to identify. So we're going to be talking more and more about that the rest of today and Wednesday. Okay, now this is page 670 in your textbook, which really doesn't help you right this moment, but it's page 2 of your handout too. So I've replicated this on the handout on page 2. So if you flip to page 2, we've got this. And what this is, off of page 670 on your textbook, this is a sample statement of cash flows. We're going to go through a bunch of real ones coming up later today and Wednesday, but this is a template for this is what a statement of cash flows is. So what I've got here, just kind of identifying the different parts of this. The first part is a statement of cash flows. If you notice, even beyond what I've circled there, it starts with the name of the company, then the name of the statement, and then the date. When we have a statement of cash flows, notice it's for a period of time. It is not one day in time. It's saying, here's our cash flows, in this case, for the year. Okay? So we've got those standard titles at the top of the statement. Then the first section we see is cash flows from operating activities. So operating activities are first. They're most important. That's why we're putting them first. They always go first. Then the next section, so we'll get back to that section, we have cash flows from investing activities. And then we have cash flows from financing activities. So we're saying, here's the cash we got from operating, here's the cash we got from investing, and here's the cash we got from financing. Then down at the bottom, we do some addition and subtraction. Down at the bottom, we end up with our ending cash balance. We're saying, okay, here's in the beginning cash balance is in there too. So we're coming up with our ending cash balance, and that's the ending cash balance that ends up on the balance sheet. Okay. So what we're doing right now is we're talking about the first segment. We just talked about the operating cash flows. And we're using the indirect method. This is a template that shows the indirect method. The indirect method starts with net income and then does a series of adjustments. Okay. So what we're doing on here is we are taking cash provided by operations. To get there, we take our accrual net income and we convert it to a cash basis net income is what's going on there. We are starting with net income, which is an accrual net income. And then we do these adjustments to it, and we're coming up with basically cash basis net income. That's where we're coming from. We're starting with our net income off our income statement, and we're going backwards, and we're going to say, if we had used cash basis accounting, which is not acceptable, but if we had, here's the cash that would have been generated by operations, because this statement is all about the cash. So cash provided by operations is our accrual net income. We start with that, convert it to a cash basis net income. Okay, so going back to our template that we have on here, in this section, what I want to show you next is that call-out box that I put on the handout. So that call-out box there, that is this section going from net income, from accrual basis net income, down to the cash generated from operations. There's a lot of adjustments, and you add and subtract some of them. That's too much to memorize. I do not want you to memorize that on the exam. So this box right here that you have on the handout, I actually took a screenshot off of it from your exam reference sheet. So this specific box is on your exam reference sheet. So you do not need to memorize anything on here. When we look at this, when we have to reconcile from net income down to cash from operating activities. We start with net income, then we have a bunch of adjustments. And the first adjustment is to add depreciation, depletion, amortization. We add back loss, we subtract gains. So each of those items tells us which direction this adjustment should be made. So if I would give you net income and a series of adjustments, a series of things, you would know whether to add or subtract. So it becomes very easy when you have this beside you. So I wanted to point that out, that this box, and that's why on the handout I've got that box specifically stating you're getting this on your exam reference sheet. You do not need to memorize this section, but you need to know it's there and it's available for you to use. Okay, so that's on page 2. And on the handout, I say you get this box. You don't get the whole statement, but the other parts of it are more intuitive. So we'll talk about this, but you get this section. Okay, so talking about this section specifically, you always, in the indirect method, when we're calculating operating activities, you start with net income. That's always where you start. Then you're going to have a series of adjustments. And on the sample statement of cash flows that I'm handing out, that I've got, that we're going to be looking at today and Wednesday, I just call them adjustments to reconcile or something. I shorten it up. But in real life, it's a very long title. It's just saying, here's the adjustments that we need to make to convert our net income on an accrual basis to cash basis. And then there's a whole bunch of adjustments. There's a whole list of them. You have them, so you just look at the list, and whether you add or subtract it is given in front of the item. And then we end up with net cash provided by or used for operating activities. Notice how it says used for in parentheses. If you take your net income and you add and subtract everything and you come up with a negative, that means your operations used cash. Your operations didn't generate any cash. They used up cash. So negative means this item used it. So sign matters. If it's positive, it's net cash provided by operations. If your number is negative after you do the adding and subtracting, then that is net cash used by operations. If you're in a loss position, if you're losing money, your operations can chew up cash, and that's usually not a very good position to be in. Okay, so see the adjustments here? We're going to have a question coming up, and this question is going to give you one of the adjustments. So, for example, if I said, what do you do with a loss on sale of long-term assets? You would know that a loss on sale of long-term assets, you would add it back to income, and I know that because there's a plus sign there. Okay? If I said, what would you do with a gain on sale of long-term assets? You would subtract it from net income because there's a negative there. If we had an increase in accounts receivable, which is a current asset, we would subtract it. Okay. If we had a decrease in accounts receivable, we would add it back. So we've got all those rules. Those rules are given to you right there. Okay? So, next question is coming up. Next question. Okay, a gain on sale of equipment is subtracted from net income when determining cash provided by operations under the indirect method. True or false? Okay, a gain on sale of equipment is subtracted from net income. When you're looking at this one, this should be really easy. It should be easy if you get this on an exam or a question similar to this, because all you have to do is look at that box. When you go back to look at the box on the exam reference sheet, you've got it in front of you on the handout. When you look at here, you say, okay, this question is asking about a gain on sale of equipment, right? And it says a gain on sale of equipment. Let me see what I do. So I look through this list of adjustments, and I'm looking for gain on sale of long-term assets, okay? Because equipment is a long-term asset. And I scroll down through the list, I see the sign in front of it, whether it's positive, which would be added. If it's a minus sign, it would be subtracted. So a gain on sale of equipment is subtracted from net income when determining cash provided by operations under the indirect method. True or false? We're going to close this in 5 seconds. That is absolutely true. Okay, now I want to go through how you actually do a indirect statement of cash flows, and we're gonna use a homework problem. So we're going to a homework problem now. And with this one, I'll email out the step-by-step, but I did want to walk through what we do here. So we have a company that began 2014 with accounts receivable, inventory, and prepaid expenses totaling $56,000. Okay, so they began the year $56,000 in those are current assets, by the way. Then at the end of the year, the company had a total of $59,000 for these current assets. So the reason they're doing that is they're saying we started the year with $56,000, we ended the year with $59,000, so we had an increase from the beginning of the year to the end of the year in current assets. At the beginning of 2014, the company owed current liabilities of $41,000, and at year end, current liabilities totaled $45,000. So again, we're given beginning of the year current liabilities, end of the year current liabilities. We can take the difference and we see there was an increase. Net income for the year is $76,000. Included in net income were a $3,100 loss on land and depreciation of $12,000. Now this problem asks us to do just the operating section of the statement of cash flows. So we're doing just the operating section. So the first thing we do, and again, we can use that little box on the page 2 of the handout. The first thing we do is we start with net income. We always start with net income. So net income is given to us as $76,000. Then we're going to add the adjustments. So we're going to have add or subtract adjustments. So we're going to have adjustments. And the first thing we're going to do is we're going to add back depreciation expense. And I know that because I'm looking at the template for the operating section on page 2 of the handout. The first item is add back depreciation. Okay. Next item up, we had a loss on sale of land, and that's one of the things we need to add up. So we just go down through the list and say, did we have this? Did we not have this? So we had loss on sale of land. Then we had an increase in current assets, and those are current assets, accounts receivable, inventory, and prepaid expenses. So we went from $56,000 at the beginning of the year to $59,000 at the end. So we grew by $3,000. We had an increase of $3,000, and we subtract increases in current assets. We had an increase in current liabilities, so we would add that back. Again, that doesn't, sometimes when you look at this the first several times, it doesn't make sense. Why are we adding back decreases in current assets? It does make sense when you go through it, but we don't have 2 weeks to study the statement. So if you're an accounting major, you're going to get it a lot in Corp 1, Corp Accounting 1, which is the first class you take as a junior. If you're not, just say, I can use the template and know that when you look at these statements, these adjustments are in there, fine, you take the operating cash flows. Just like we're going to do when we start looking at real statements. Okay, so then what we're going to do to finish this out is we're going to add all those items up and subtract the one negative, and we get net cash provided by operating activities. Again, I'm sending out the URL for this where we walk step by step, but I at least wanted to show one in class today. And the real life ones were pretty lengthy. It would be beyond what we wanted to do in here. So it's just a quick showing how you're going to use that. So you have to use that little box that you have on the exam reference sheet, so that should help. Okay, one more question about that box, about those adjustments to reconcile. Okay, an increase in accounts receivable would be added to net income when reconciling net income to net cash provided by operating income. Accounts receivable is a current asset, if that helps. So accounts receivable is a current asset. Okay, an increase in accounts receivable. Accounts receivable is a current asset. So you look on page 2, that big call-out box, you have an increase in current assets. Do you add that? If you look at the box, is it got a plus symbol there? Okay, again, when you're doing this, make sure you're looking at the sheet. Don't just guess. We've got an increase in accounts receivable, so we have an increase in a current asset. So if you look at the sheet, scan down for where it's talking about increases in current assets other than cash. Okay. Does that have a plus symbol in front of it? If it does not have a plus sign in front of it, you would put this false. Okay, 5 seconds. That is false. You add those back. Okay, and then one more before we go on. Okay, depreciation expense is reported on the statement of cash flows as what? We've got operating, investing, and financing. Okay, depreciation expense. Depreciation expense we actually see listed as one of the adjustments on that box when we're looking at the statement. And you see when we have this statement, we start with net income. The operating section starts with net income. The very first thing you add back is depreciation expense. So it is an operating expense. I'm going to close in 5 seconds. Okay, so now we're back to our statement, so we're still on page 2 of the handout. And now we're going on to the investing activity section. So we've kind of gone through the operating. Operating are those things that generate income for us. The expenses, the revenues, all of that, the gains and losses are in the operating section. So now we're down in the investing section. The investing section is everything to do with long-term assets. So this investing section, okay, investing section, we've got several things. We can have sales of long-term assets, purchases of long-term assets, collection of notes receivable, loans to others. So those are examples of things that can be in this section. The reason we're adding when we have sale of long-term asset, keep in mind this statement is all about the impact on cash. If we sell a building, cash is going up. We're getting cash. So if we sell something, cash goes up. On the other hand, if we go out and purchase new equipment, that's a long-term asset. If we purchase new equipment, then we're spending cash and cash is going down. Collecting notes receivable. Then we get paid back on any notes receivable. It's a long-term asset. We get cash, so that's added. If we make loans to others, if we loan money out, then cash is going down. So we've got those kind of things going on in the investing section. Okay, investing, the big key to remember with the investing section is investing activities impact long-term assets. Okay, so investing activities impact long-term assets. Our long-term assets are things like property, plant, and equipment, so land, building, equipment. Other long-term assets are intangible assets, copyrights we have, patents we have, long-term bonds that we've invested in, stock in other companies. Okay, every cash flow item is either a source of use or use of cash. So every cash flow item that we see in the investing section and the financing section, it's going to either increase cash or decrease cash. In this statement, we look at everything through this lens of how does it impact cash. Does cash go up or cash go down? We typically call things that make cash go up sources of cash, and other things uses, and that's loose terminology, but that's every cash flow is going to be added or subtracted. So we have a source making cash go up. We have a use making cash go down. Okay, now page 1 of your handout has this item, okay? So page 1 of your handout has this listed. These are examples of investing activities. So positive items, things that cause cash to increase, or sources of cash would be things like sales of plant assets. So that would be a sale of land, a sale of a building, a sale of equipment, a sale of a delivery truck we're no longer using. Those would cause cash to go up. Sales and investments that are not cash equivalent, so these are the long-term investments, the stock in other companies, the bonds in other companies, collections of loans receivable or collections of long-term notes receivable. So those are all things that would cause cash to go up. Items that cause cash to go down, the negative items, the items that are uses of cash. What do we use our cash for? We buy things. We buy new buildings. We buy land. We buy new equipment. Purchase of investments that are not cash equivalent. So this, we go out and we buy stock in another company. We buy bonds. We buy these long-term investments. And also if we make loans to others, that would be a use or a negative item. And again, this box is on page 1 of the handout under investing activities. Okay, so now we have a question out there. Purchase of land with cash. So we go out and buy a piece of land. We're going to put a building on it. So we go out and buy this land. How is it? Where is it reported on the statement of cash flows? When you're answering this, land is considered to be a plant asset. That's the terminology. It's property, plant, and equipment. Land is a long-term asset. It's called a plant asset. So we are acquiring or buying land. We're buying a long-term asset. Where does that go in the statement of cash flows? I'm going to close this in about 5 seconds. Purchase of land is a plant asset. It's a long-term asset. Okay, it's an investing activity. Okay. Okay, so marching our way down the statement then, the next section is this section, cash flows from financing activities. Now, financing activities, there's all sorts of those. We're going to see, just so you, this is, we're going to be on page 1 of your handout just a minute, but on page 2, this section talks about issuance of stock, sale of treasury stock. All financing cash flows come from long-term liabilities and equity. So financing cash flows come from long-term liabilities and equity. So if it's related to a long-term liability or related to equity, it's going to show up under financing cash flow. Okay, so financing cash flows come from long-term liabilities and equity. Those two sources are where our financing cash flows are coming from. So again, on page 1 of the handout, you have financing, examples of financing activities. We have positive items, things that increase cash. Would be issuing stock. We issue our stock. Investors give us cash. That would cause cash to go up or increase cash. Selling treasury stock. This is our own stock we bought back. We can sell it again. That will give us cash. If we borrow money, if we go to the bank and we borrow money, or if we issue bonds, long-term bonds, that's going to be a source of cash. So in the financing section, if we do any of these items, we get cash, right? We issue stock, we borrow money. Okay, negative items. We pay dividends. That's a use of cash. We purchase our own stock back. We're going out to the market getting our own stock, so our cash is going down. We have to pay cash to get our stock. And when we pay back loans, that causes cash to go down. Okay, so, this is in your book, and this is another way to look at, this is exactly what we've been saying. When you're looking at the balance sheet, current assets and current liabilities, changes in those items other than cash itself, affect the operating cash flows. The long-term assets on the balance sheet are investing cash flows. And then long-term liabilities and stockholders' equity, things that impact those accounts, are financing cash flows. So when you look at the balance sheet, you could split it up between operating, investing, and financing by what type of account is underlying there. That is Exhibit 12.2 in the textbook. Okay, so next up. So thinking about this, our next question, paying bonds payable. So bonds payable. So you know, bonds payable is a long-term liability. Bonds payable is a long-term liability. So where is that going to show up on the statement of cash flows? Long-term liability. When you're looking at the first page of the handout, if you're unsure, well, first of all, this is a long-term liability, and hopefully you wrote down what kind of activities deal with long-term liabilities and equity, or what kind of cash flow. But also, if you're looking at the example items of financing activities on page 1 of the handout, this would be considered payment of principal amounts of debt. Okay. So paying bonds payable. Bonds payable is a long-term liability. And actually, if we go backwards here, oops, there we go. Okay, so bonds payable is a long-term liability. So you ask yourself, where does it show up on the balance sheet? Long-term liability, that's a bonds payable. That is what kind of cash flow? Okay, listed right there. I'm going to close this in about 5 seconds. That's a financing activity. We're going to do another one here. Payment of dividends. So payment of dividends is also on page 1 of your handout. Okay. So payment of dividends, where does it go on the statement of cash flows? Okay, so payment of dividends. When we talk about payment of dividends, they're actually listed there as on your page 1. Okay, payment of dividends is on a section. Okay, payment of dividends is on page 1 of your handout. Hints would be in the lower left-hand corner. So I'm going to close this in about 5 seconds. Okay, financing activities. Again, those sample activities that are on the lower corner, we've got investing activities and financing activities. You're going to need to be able to identify what types they are. So those are important things to know to be able to say, does this relate to a long-term liability or equity? Dividends relates to equity, okay? Or is it a long-term asset, which would be investing activity, and then we've got the other thing, the operating activities that go in the operating section. Okay, so what we see now, okay, we've gone through the statement. We have the, at the end, we add or subtract all our net increase or decrease. Then we're going to add our beginning cash to that and get our ending cash. So at the bottom of the statement, we're reconciling to end up with how much cash we have on our balance sheet. Okay, so the first thing we do, we add those 3 items together to get our net increase or decrease, and then we add that to our beginning cash, and we come up with our ending cash at the end of the period. So again, this is the page 2 on your handout. Now, for the rest, pretty much for the rest of this chapter, what we're going to do is the next several pages of your handout. So what I did is I picked 5 companies, and then I said, let me find a company to compare each one to. So this first set, and this is where that handout's going to be invaluable, is the first set that we see on page 3 is comparing Microsoft and Apple. So what we're doing, what I've done here, is I've given you the statement of cash flows for 2 companies. And it's almost like who wore it better? You know, who did better cash flow-wise, Microsoft or Apple? So this first one is Microsoft, and some things I want to clear up here. First of all, the first thing we do when we look at a statement of cash flows is we look for the period ending. So we see this is Microsoft's year end is June 30th. Okay, so that's fine. That's coming up on, they're not going to issue new statements. We won't see those till September or so. So this is the most current. And then it's in millions. And some of these statements I'm showing you are in thousands and some are in millions. And also you'll see that there are 3 years for every statement. That's because this is required by the SEC. Remember the Securities and Exchange Commission. These are all publicly held companies. They have to produce audited financial statements, and those audited financial statements need to contain 2 years of balance sheets and then 3 years of these other statements. So we have 3 years, and that's always very useful to see. And then the other thing I wanted you to know is I took these statements of cash flows and I converted them, adapted them for classroom use. So the first section, the operating activities section where we have net income, I just put all the adjustments together. So they would have gone through. If you look at their actual financial statements, if you look at their actual statement of cash flows, they've probably got 15 items to reconcile net income to a cash basis. But I just put those as one, so we're not going to focus on that. I wanted to get the total of the operating cash flows. So we have the operating activities first, then the investing activities, and then the financing. Operating activities are always first. Usually we have investing and then financing, except once in a while companies will flip those and they'll go financing and investing. But for our purposes, we're going to do operating, investing, and financing in that order. So I've adapted this. What I've done is I've kind of condensed things. A lot of times there's really odd things on a statement of cash flows, and I kind of tried to put those in another category for us. So what we have here for Microsoft, just kind of doing a once-over, Microsoft generated $29 billion of cash from operations in 2015. They used $23 billion in investing. Investing means they're investing in themselves. They're growing. And then financing, they used cash for financing, and what did they do? They repurchased a bunch of common stock and they paid dividends. This is in 2015. So we can see that. So what I want to do is I want to stop here for today, but I want to just set it up for what we're going to be doing. So on Wednesday, what we're going to be doing is we're going to be actively comparing the rest of the statements. You've got 10 statements of cash flows in the handout. I'm going to be asking you questions about them. We're going to turn to each company and I'll ask you questions about interpreting that. So we're going to look at Microsoft, we're going to look at Apple, we'll compare them, and we'll ask individual questions. So you need the handout on Wednesday. If you're online, you might want to print it out. If you need that, if that works better for you, you will definitely need the rest of the handout on Wednesday. So that's where we're going to pick up on Wednesday, and I will see you. I'm going to put out a feedback question if you want to fill that out. Good. Okay, so that's all we have for class. Have a nice day, and I'll see you on Wednesday.